Hello, and welcome. If you're looking to get a clear picture of what's been going on in the financial world lately, well, you're in the right place.
That's right.
Today, we're doing a deep dive into recent market moves and some key economic developments. We're basing this on an analysis recorded just yesterday, Monday, May 12th, 2025. Our goal, really, is to pull out the most important insights from that analysis, help you grasp the main trends and, what they could mean, all without getting too technical.
And as we're both looking at this from a financial background, we'll share our perspectives and, try to break down any complex bits.
Exactly. So where should we start? Maybe the U.S. stock market last week.
Okay, sounds good. Looking back at last week, overall volatility was pretty low, actually. But then Thursday and Friday, we did see some positive news filtering through.
Right.
One thing that caught my eye was this first round trade talk agreement, the U.S. and U.K. What's notable is that even the U.K., very close ties to the U.S., runs a trade surplus for the U.S. in goods. They still couldn't avoid this new 10% tariff.
A 10% tariff,
Okay.
even for the UK.
Yeah. It makes you think, doesn't it? Could this sort of low-level 10% tariff become like the new normal across the board for different countries?
That's a really interesting question. A new baseline, maybe.
Yeah.
And speaking of international developments, we've got former President Trump heading to Saudi Arabia, Qatar, and the UAE soon, May 13th to 16th.
Right. Oil trade discussions are almost certainly on the agenda there.
Yeah, you'd think so. Could they get the markets a little positive nudge if things go well?
It certainly could. It's another potential catalyst, absolutely. And sticking with trade, the first round of U.S.-China talks, the ones in Switzerland, they've wrapped up. A joint press conference is apparently coming. Now, look, tariffs are probably going to stick around in some form. I think that's fairly certain. But the strategy seems to be, well, they're sort of drip-feeding any potentially good news about reductions rather than a big reveal.
Yeah, it does feel like a very managed release of information. Keeps everyone guessing, maybe.
Exactly. It keeps things interesting.
But it also makes me wonder, what if it all works out? Hypothetically. U.S. and China sort things out completely, other trade deals fall into place. Would the current market optimism, the recent gains, look a bit premature in hindsight?
That's a great what if to consider. If we get that, perfect resolution scenario, then yeah, maybe the current optimism looks a bit overdone later. But we also have to look at the technical picture.
Okay.
The charts for the NASDAQ 100, the S&P, the Dow, they're all approaching their yearly moving averages. And importantly, those averages are actually curving downwards right now.
Ah, right. That often signals potential resistance, doesn't it? Selling pressure.
It can, yes. Technically, it suggests there could be some headwinds there.
But then you look at something like Bitcoin. It's actually broken into positive territory for the year, up around 9%. And some chart watchers are pointing to this 3 bulls and 1 bear pattern, seeing it as quite positive.
That's a fascinating contrast.
So is Bitcoin maybe signaling a different mood, a sort of risk-on appetite, despite the challenges in the traditional indices?
It's definitely something to keep an eye on. Bitcoin's performance could be an indicator of broader risk sentiment, for sure. So if we zoom out and look at asset classes overall this year, it's a bit of a split picture.
How so?
Roughly 70% of the major asset classes are actually up year to date. About 30% are down.
Okay, so mostly positive.
Yeah.
And where are the big winner?
Well, gold has been phenomenal, up 26.7%, really strong.
Wow.
And then European and Asian stock markets have also done very well, up around 13.7%, with Europe really leading the charge there. And as you mentioned, Bitcoin's up about 10%.
So gold, non-U.S. stocks, Bitcoin, clear standouts.
Exactly. Then you've got more modest gains, sort of in the 1% to 3% range for things like emerging market stocks, short-term T-bills, EM bonds, U.S. aggregate bonds, convertibles, high-yield bonds.
Okay, so some positive returns, but smaller.
Right. But what's really interesting is the performance within the U.S. market. Large cap, mid cap, and particularly small cap stocks, they've lagged. The IWN index for small caps is down almost 9%.
That's quite a divergence. It really suggests that outside the U.S., most stock markets have held up reasonably well, maybe especially those not at the center of the tariff disputes.
Precisely. And the stronger euro has definitely been a tailwind for European markets.
Which brings us to this stark difference in global equity performance you mentioned.
Yeah, it's quite striking. You look at the S&P 500, down about 2.9% year to date. Then you look at the MSCI World Index. It's up 12.9%.
12.9%. That's huge. So basically, avoiding U.S. equities this year has paid off handsomely.
It really has. And that's a key point for many investors. investors, especially perhaps for listeners here in Taiwan who often have significant U.S. market exposure.
I'm sure that resonates. And this U.S. underperformance, it seems linked to foreign investors selling, right? Since February or so.
Yes, there's been a noticeable outflow from U.S. stocks and bonds by foreign investors starting around February, maybe through April.
So why are European markets doing so much better? What's drawing the money there?
Well, a few things seem to be playing into Europe's strength. There's a lot of old money, large pools of capital and pension funds, family wealth, and so on. And generally, there seems to be more excess savings floating around in Europe currently.
Okay.
We've seen estimates of nearly $300 billion flowing out of U.S. markets in just 3 months. That's significant. It could signal worries about, high valuations, especially in U.S. tech, and maybe uncertainty around former President Trump's policies.
$300 billion is a massive number, and that money seems to be finding a home in Europe. We saw the German DAX hit a record high, didn't it?
Exactly. The DAX hitting a record and outperforming the broader European CEFI X 600 index, it really points to strong capital inflows and likely expectations that the euro could strengthen further.
Interesting. Now let's shift focus closer to home. What about the Taiwanese stock market?
Well, the Taiwan market, it's been, frankly, relatively weak. Yes, we've had 3 weeks of gains, but it still hasn't fully clawed back the losses from April.
Right.
Now, there have been bright spots. Over 30 listed companies saw their stocks jump more than 10% just last week, and there has been some foreign buying.
But not on the scale of Europe, presumably.
Not even close. If you compare the appreciation of the new Taiwan dollar and the euro year to date, they're actually quite similar. But the foreign buying in Taiwan is much, much lower, about NT $22.7 billion compared to the huge flows into Europe.
That's a stark difference.
Yeah.
And you mentioned foreign investors increasing bets against the market.
Yeah, we've seen an uptick in foreign short positions in Taiwan futures recently. It might suggest they just don't see enough opportunities for sustained, broad-based buying in the Taiwan market right now. Perhaps not enough cyclical opportunities.
And it feels like local retail investors aren't exactly rushing in either.
That's the other piece. Margin lending borrowing to buy stocks hasn't really increased much, even though the Taipei index is up something like 4,000 points since the April low. It points to pretty weak sentiment among individual investors here.
So you have similar currency appreciation, NTD and euro, but vastly different stock market performance and foreign flows. It really underscores Taiwan's current relative weakness.
I think so. So summing up the global picture, most major stock markets are actually in a pretty strong bull phase. The main exceptions seem to be the U.S. and some East Asian markets caught up in these trade tensions.
And for Taiwan specifically, maybe it's that weak retail confidence hindering rotation between sectors, plus the market's fairly heavy ties to those potentially overvalued U.S. tech stocks.
That seems like a reasonable assessment of the situation, yes. Which brings us back to the trade negotiations. How are they actually progressing?
Right, beyond the headlines.
Well, while everyone hopes for breakthroughs, that idea we touched on, the gradual release of positive news, might actually be better for sustainable market growth than one big announcement.
Keeps the rally going, perhaps, instead of a buy the rumor, sell the fact situation.
Potentially. Now, let's look at that U.S.-UK deal again.
Yeah.
That 10% tariff seems to be the new floor, the starting point, even for countries that had, let's say, preferential import status before.
So 10% is the new zero, in a way.
It kind of looks that way. And that the specific deal for UK cars, 100,000 allowed in at 10%, then 25% tariff on anything above that quota system itself is interesting.
Oh, so?
It suggests this might be a model the U.S. uses with other countries. It echoes in some ways historical practices where East Asian countries had quotas on certain goods exported to the U.S.
A familiar tool, perhaps. And for the UK car industry, is that 100,000 limit significant?
Well, considering the UK exported about 102,000 cars to the U.S. in 2024, it means most of their current volume falls under that lower 10% tariff. So it's probably quite beneficial for them.
Okay.
Plus, there's the new Steel and Aluminum Alliance, zero tariffs for UK steel and aluminum if the UK cooperates on tackling non-U.S. trade barriers. And mentions of digital checks for U.S. agricultural products. It's clearly just phase one.
But the analysis we're drawing from also raise a counterpoint, right? that this kind of deal might be seen as negative for countries with large trade surpluses with the U.S., thinking East Asia, China, Vietnam, Germany, Taiwan.
That's the concern, yes, that those with big surpluses might be next in line for similar or maybe tougher negotiations. However, the analysis also challenged the common perception of the U.S.-UK trade balance itself.
Oh.
By pointing out the single largest U.S. export to the U.K. is gold, around $10 billion worth.
Gold, not cars or machinery.
Right. And this is largely because London is the global hub for the over-the-counter gold market. It's about institutional trading, storage, clearing, not necessarily $10 billion of gold being bought by UK consumers.
Ah, I see. It's a financial flow, not necessarily goods trade in the traditional sense.
Exactly. So if you strip out that gold factor, it's quite likely the UK actually runs a trade surplus with the US in goods and services. They probably sell more to the US than they buy from the US, excluding gold.
So from that perspective, locking in a 10% tariff might actually be a win for the UK.
It could well be. Their exporters potentially benefit more from access to the US market than US exporters benefit from access to the UK market, again, ignoring gold. So yeah, maybe the UK did quite well there.
That's a very nuanced take. Okay, let's pivot to the U.S.-China talks. They finished the closed-door sessions in Switzerland, press conference pending. We heard China's vice premier mentioned substantial progress. What could that realistically mean?
Substantial progress.
Yep.
Well, it likely touches on a few things. Some tariff reductions seem probable, maybe lifting some of the executive orders impacting trade or investment, perhaps even setting the stage for a leaders' meeting down the line. Now, you always have to take official statements from both sides with a degree of caution. Their credibility can be questionable at times. But given the global pressures, it seems plausible some real steps forward were made.
And former President Trump has also sounded somewhat positive recently.
He has. He mentioned the tariff negotiations with China being very effective and talked about needing to ease tensions by lowering tariffs that are excessively high, though without giving specifics.
So a generally constructive tone, at least publicly. The original analysis also mentioned a Goldman Sachs forecast.
Yes, projecting quite significant potential tariff cuts, down from maybe 145% to 50% on Chinese goods entering the U.S., and from 125% down to 45% on U.S. goods going into China.
Those are big drops. What would that mean for, say, Taiwanese businesses?
Well, currently, Taiwanese firms often face lower U.S. tariffs than their mainland Chinese competitors. If China's tariffs come down significantly, that relative advantage shrinks.
Right. Less of a competitive edge based purely on tariffs.
Exactly. And it underscores that even with reductions, uncertainty remains. Short-term tariff changes will almost certainly create market volatility. You just have to expect that.
Absolutely. That report on West Coast port activity was also quite telling, wasn't it?
The one from Jin N. Yes, very interesting. 0 ships from mainland China waiting offshore yesterday compared to 41 just 6 days before, while ships were waiting to enter. It strongly hints at anticipation of a positive deal announcement, like holding off shipments until potentially lower tariffs kick in.
Makes sense. So while 0 tariffs seem unlikely,
Very unlikely.
the goal for Taiwan, ideally, is just not to end up with higher tariffs than China faces.
That's the key benchmark, really. But this whole situation has been so fluid since February. Remember the Japan talks. Initial positive signals, then they stalled.
That's right. And Japan seems to be pushing back now.
Yeah. Japan's Trade Minister Ishiba publicly rejected a UK-style quota system for their auto exports to the U.S. just a couple of days ago, on May 11th. He cited their much larger export volumes compared to the UK and the huge investments Japanese automakers have already made inside the U.S.
So they're drawing a line.
It looks like it. And
Yeah.
the U.S.-Japan negotiation timeline has slipped, pushed from June to July, with plans for a direct meeting between leaders. Japan seems willing to wait for better terms rather than accept a deal they feel is unfavorable, possibly due to domestic pressure.
A firmer stance from Japan, then.
Yeah.
So stepping back, what's the bigger picture on former President Trump's overall trade policy direction? Are the core goals still the same?
I think the core goals haven't changed. Reduce trade deficits, boost U.S. manufacturing, curb illegal immigration, secure supply chains. Those seem consistent.
Okay.
We've seen the auto and steel aluminum tariffs have had somewhat limited impact, partly because a lot of that production happens in Canada and Mexico, protected by the USMCA agreement. The real bite of the tariffs has been on consumer goods from China. And even if those tariffs on Chinese goods drop to, say, 40–50%, that's still likely to mean some price increases for consumers. We'll be watching the May and June inflation numbers closely for the first signs of that impact.
So trade remains front and center. But the analysis also touched on geopolitics, noting that global peace hasn't exactly flourished since Trump's election.
That's a fair observation. The Iran nuclear deal remains stalled, the conflict unresolved, and Ukraine.
Well, Putin mentioned restarting peace talks around May 15th. We saw European leaders meeting in Kyiv.
Macron, Schultz, Tusk, the UK PM.
Right. So there's talk of a new round of peace talks maybe mid-May, apparently without direct involvement from former President Trump this time. But then you have the U.S. Embassy in Ukraine warning about potential major airstrikes soon.
Suggesting the U.S. has its own intelligence and concerns separate from those European talks. Exactly. And the fighting itself remains intense. That data mentioned from CIT about fewer military vehicles in Russia's recent Victory Day parades, fewer tanks, fewer rocket systems, older artillery being shown. It does suggest both sides have suffered heavy equipment losses.
A grim reality. But as the analysis suggested, the market seems more focused on the trade deals than these geopolitical tensions right now.
It does seem that way. Market optimism appears tightly linked to progress, or perceived progress, on reaching trade agreements. The geopolitical risks are there, but maybe taking a back seat for the moment.
Okay, so if trade is the main market driver, what about domestic U.S. policy under Trump? Could that be a bigger catalyst?
That's where things get really interesting and potentially more impactful for market sentiment. But there seems to be some internal disagreement, perhaps, within the White House on tax cuts.
Oh.
Yeah, the Financial Times reported on internal meetings where former President Trump apparently floated a rather surprising potential tax plan.
Surprising how?
Well, it reportedly involved raising taxes on the wealthiest Americans' maybe income over $2.5 million taxed at 40%, and discussing this with congressional Republicans. The idea being potentially to use that revenue to fund broader tax cuts elsewhere.
Wow. Raising taxes on the rich to fund other cuts.
Yeah.
That's not the traditional Republican playbook of trickle-down economics.
Not at all. You can imagine the reaction on Wall Street if a sort of wealth tax was seriously considered to finance tax relief for lower and middle income groups.
Definitely some raised eyebrows, maybe some pressure.
For sure. And Trump's comment that he'd be open to it if Congress passed it, that likely caused some nervousness among fund managers and high net worth individuals. We're even hearing about major foundations discussing how they might respond to potential tax hikes.
And the potential revenue from that, you're saying, could fund pre-midterm election tax cuts or other domestic reforms.
That seems to be the idea being floated, yes. Alongside that, the analysis mentioned a White House press release claiming historically low illegal immigration number.
Right, freeing up funds.
Exactly. And those funds apparently are being redirected to support homeless veterans who, the release noted, often received less funding previously than was allocated for accommodating illegal immigrants.
And then there was that social media post.
The free plane tickets offer for deportation.
Yes.
It's another example of his unconventional approach to policy.
It really highlights this sometimes paradoxical nature, doesn't it? Using government intervention, like creating a government efficiency department to cut staff to achieve conservative goals.
It's that left-right paradox the analysis mentioned. Now, while his domestic approval ratings have dipped a bit, it's apparently not drastically different from his first term. Overseas approval has dropped more sharply, though.
And the long-term impact of all these policies?
Yeah.
It takes time to see, right?
Absolutely. Some policies might erode trust gradually. Others could still yield positive long-term results. The analysis argued his overall strategic direction might be more coherent than critics assume. Even those 10% tariffs, while not sounding huge, could still force significant supply chain restructuring over time.
And it's a fair point that the China tariffs from his first term weren't reversed by the subsequent administration. These things can become sticky, regardless of who's in charge.
They can become the new baseline. It makes you wonder about the long-term effects on U.S. cities from the immigration policies, too. Will social order improve? Will resource burdens ease or worsen over the next few years? It's a key area to watch.
Definitely complex, long-term questions. The analysis then brought in a couple of broader anecdotes and reflections. The first was about the 1977 NYC blackout.
Right, and the surprising baby boom that followed about 10 months later. The point being that negative events can have unforeseen, sometimes even positive consequences, and the full impact often isn't clear for a while.
It's a great illustration of delayed effects. And that led into the recent news about Taiwan's demographics.
Yeah, the sobering statistic. 16 straight months where deaths have outnumbered births. And April 2025 apparently saw the lowest monthly birth number ever recorded in Taiwan, around 8,600, while deaths were about double that at 17,000.
That's stark.
Yeah.
And the analysis tried to connect this to recent economic events.
It did, suggesting a potential link. Remember the stock market dip in July-August 2024. That was partly due to the yen-carry trade unwinding. The idea proposed was that the financial anxiety around that time might have influenced couples' family planning decisions, leading to fewer births roughly 9 months later, around April 2025.
An interesting, if speculative, connection between market volatility and birth rates.
And there was another link suggested to the housing market. Housing prices and new mortgage applications peaked around July 2024, driven by low rates. Then policy tightened in September.
Okay.
The suggestion was that perhaps the smaller living spaces in newly purchased homes, combined with the subsequent economic uncertainty, might also have contributed to decisions to delay or forgo having children.
So financial anxiety plus maybe smaller homes impacting birth rates. It's a complex mix of factors.
Very complex. The analysis then speculated that the stock market rebound since September 2024 might lead to a slight uptick in births around July 2025. But then the reemergence of those equal tariffs in April 2025 could theoretically dampen enthusiasm again, potentially affecting birth rates around February 2026.
It really drives home that point about time lags, doesn't it?
Yeah.
Seeing the ripple effects of economic and policy decisions play out over months and years.
Absolutely. It's crucial to keep that perspective. Now, just quickly recapping the U.S. market close from the time of the recording yesterday.
How did things end up?
The Dow Jones was down slightly, 0.29%, closing around 41249. S&P 500 down even less, 0.07% at 5659. NASDAQ managed a tiny gain, up 0.04% at 17900. And the Philadelphia Semiconductor Index did better, up 0.81% to 446.
But still bumping up against those yearly moving averages we talked about.
Yes, that resistance level is still very much in play. Another point mentioned was the sheer volume of corporate stock buybacks happening in the U.S. right now.
Oh, yeah.
Potentially exceeding $1 trillion. It suggests companies have plenty of cash, but maybe they're prioritizing boosting their share price through buybacks over, say, capital investment right now.
Interesting allocation of capital. And how do the big tech stocks fare? The Magnificent Seven, or however many we're counting now.
It was pretty mixed, actually. Only NVIDIA up around 5% and Microsoft up between 1–4% depending on the measure showed gains. Broadcom, TSMC, Amazon, Google, Apple, Tesla, they were all down significantly.
So not broad strength in tech.
Yeah.
And Tesla.
Tesla's stock price had actually fallen back to levels seen before those equal tariffs were announced. The previous peak seems to have been driven by pre-U.S. election optimism that has now faded somewhat.
Got it. And finally, the Taiwan market close.
It closed up 118 points, around 21033. But the analysis reiterated that point about the big 4,000-point rally since April happening without a corresponding rise in margin lending and on relatively low trading volume. Still suggests that underlying caution.
Okay. So pulling it all together, what are the key takeaways for investing from all this?
I think the main message is don't get caught up solely in the short-term news cycle, especially around trade deals. That just creates noise, random price swings.
Focus on the bigger picture.
Exactly. Focus on the broader economic expansion, but also acknowledge that this expansion is pretty mature now, at least 2 years in, maybe 12 months at this higher level. You need to return to your fundamentals.
Your original investment logic, why you invested in the first place.
Precisely. The analysis used that analogy, flipping the order of traditional Chinese sayings about family and career, suggesting you need to find the true source or foundation of your investments. Don't just chase headlines.
Solid advice. So as we wrap up this deep dive, we want to leave you, the listener, with a couple of questions to ponder.
First, considering this divergence we've seen, strong performance in Europe and Asia, relative weakness in the U.S., what adjustments, if any, are you thinking about for your own international investment strategy?
That's a great question. For me, personally, it definitely makes me reconsider the weighting towards U.S. small caps. And the strength in Europe, especially given the capital flows, makes it look more attractive than perhaps it did 6 months ago. It prompts a review, for sure.
And the second question, given all the uncertainty around trade talks potentially resolving, but maybe not fully, and these potential shifts in U.S. domestic tax policy, what factors will be most crucial for you when evaluating future investment opportunities?
For me, thinking about that, it comes back to fundamentals. Understanding the long-term earnings power of companies, regardless of short-term tariff noise, and also thinking about how potential tax changes, especially if they impact consumer spending or corporate investment, might play out across different sectors. It requires digging deeper than the surface news.
Absolutely. It's about looking through the short-term volatility to the underlying trends and company strength.
Well, thank you so much for joining us for this deep dive today. We really hope breaking down this analysis has given you a clearer picture and some valuable food for thought.
Keep learning, keep questioning, and apply these insights wisely.
We'll talk to you next time.